Howdy, Jacob here. Today we're looking at Fox Corporation in the media industry, 25 billion market cap, 28 billion enterprise value. I'm sure people have heard of Fox, been around for quite some time. Their growth in revenue is pretty much what I would expect for a company as big as they are. You're probably looking at 3 to 6% year over year compound annual revenue growth for the last 10 years or so. And their gross margin is pretty much 100%. Operating margin declining. I don't like to see that, especially for a company as mature as them. Return on invested capital going down from very solid double digits to now mid to upper single digits. Figures I don't really like to see as much. Looks like their SG&A has gone up, but mostly those other operating expenses, so likely licensing expenses and things costing them more, media rights and all that are not increasing bottom and honestly top line very much. They're a non tangible asset. They're a very intangible asset heavy business, which we can see by their goodwill, other intangible, and other assets being well over 50% of their total assets. But 6.6 billion in long-term debt, 600 million short-term debt, 4.3 billion cash on hand. Not terribly concerning if they make over $1 billion or so, which they do. Not concerned about their debt figure at all, especially with how long they've been around, and their production of free cash flow being as great as it is and as positive as it is. Definitely not concerned. Their use of cash is mostly share repurchases at this point. It looks like in the last 5 years, I would say a good 80-90% or so have gone to share repurchases, with paying a dividend that is 15% or so of their free cash flow. They're paying down some debt. And they're also making some acquisitions and reinvestments, but mostly share repurchases at this point. So let's get to making some assumptions for revenue growth. Maybe they'll make some acquisitions and some reinvestments to grow a little bit beyond inflation, let's say 4% or so. I think that they're pretty average business, so I'm going to give them market average terminal P, price to free cash flow. For margins, we're looking at free cash flow is a bit higher. I like that. But again, they've been decreasing over the last 10 years or so, which I don't like. So maybe let's do 10 and 11% share change. They're buying back a lot of shares. 1% for them is about $250,000. And with offsetting stock-based compensation, even still, let's do minus 4%. Their dividend, they can definitely afford it. Have they increased that in the past? Okay, a little bit. So let's increase it pretty much just with inflation to say that they can increase it every year. And we're saying the stock price needs to fall 41% before you get the return looking for here. So honestly, not terribly far off. Honestly, if anything's within 50%, I say that it's very manageable, since companies' stock prices vary heavily in a year. Um, especially in a market that things on the average company might be a bit overpriced in my eyes, then to be this far off is not terribly concerning, or is not likely going to take a lot of time. But in my eyes, the declining operating margin, declining return on invested capital, just things I don't like to see. But again, I think this is going to be a pretty consistent business. And so investors love consistency. With that said, still 41% off the price we're looking for here. So hope you just fitting. Have a great day. Thanks.